Let's get across the market open. Marcus Padley joining us from Marcus today. Marcus, welcome. Good to see you after the Easter break. Hope you had a good one. Now, of course, one day markets are up, the next day they're down. They're up again today. So much of this, of course, depends on what comes out of the mouth of Donald Trump. Now he's backtracking to say, look, you know what? He doesn't want to get rid of Jerome Powell.
I know, and another head fake, but we're getting used to it. I think also we need to recognise that some Fridays and Mondays, Wall Street goes sharply in one direction, then reverses the next. So post Easter, we've come back, had a sharp down day, and today we've recovered almost a whole thing. I think the Trump comments as well have come after market close, or pretty much on market close. So whilst we had a good session in Wall Street overnight, if you have a look at the the after hours prices on big tech and everything else, you'll see there have been some fairly sharp after hour moves. We've got Nvidia up 3%, Amazon up 3%. Tesla on its results up 4.7%, Meta up 3.9%. So we've had a good session, and we're following through again. And it's a combination of Trump. Finally, someone must have influenced him to say you really have to backtrack on the Powell thing. So he said that. And we've also got some mild progress on trade optimism. With both Trump and Bessent saying mildly positive things about an eventual deal with China.
Yeah, it seemed to be that potential breakthrough with China-US trade. Also, the earnings reports, as you mentioned there, clearly the focus was very much on Tesla.
Tesla, I would just be careful of Tesla. I mean, I know it's in Magnificent Seven, but it's not a stock that is indicative of how the rest of the economy is going or how big tech is going. It's maybe the share price might be a sentiment indicator, a bit like Bitcoin, really, but it's not a driver of other share prices. So it's a bit of a one-off, and it's up 4.7% on, despite backing off on their outlook statement a little bit. And I think maybe it's to do with Elon Musk saying he's going to step back from Doge activities in May and focus more on the company. But I don't know whether you saw the guy from ARK Invest talking about Tesla and how it will become a robo-taxi company. But it's ahead of its time. You know, it's an expensive stock. And the future, the problem with visionaries is they're looking 10 years out at least to a robo-taxi company, and we haven't got time to invest in that this week, this month, or even this year. So nice story, ARK Invest, but that's been their modus operandi to excite us about the future whilst destroying us in the short term. So not really too influenced by Tesla's results one way or the other. The main results are going to come later this week. I think we've got Microsoft, Amazon, Alphabet next week, Meta. Let's look at those, not Tesla.
What else are you focused on, particularly what the US investment banks are doing at the moment, Marcus?
They are having a fabulous rally overnight. When we cashed out, as you know, at the end of February, and bought back in after that 12% pop in the NASDAQ in a night, we saw that as the bottom of the market. And but rather than buying into big tech, which we saw as maybe a sector that was overvalued, we bought the banks ETF, BNKS, which is international banks. The biggest holding there is JP Morgan. So it represents US investment banks. And we have seen, for instance, I think Goldman Sachs is still 22% off the top, despite the fact it's bounced 18%. And there's still tremendous upside. If this trade tension went away, there's still I think the JP Morgan, the biggest holding in that bank's ETF, is still down 16% from the top, and the others are down 2018, 22, 22, 18. So there's plenty of upside if the market relaxes a little bit. So we bought into that. And we also bought into the copper ETF wire. And the copper stock's looking absolutely fabulous today, thankfully. But that was more the idea that we had overdone it on recession fears. And we didn't want to buy into iron ore and coal stocks because the Chinese economy may take longer to recover. But we did think we'd hit peak recession fear. So we bought we bought an exposure to copper. The other thing we bought was MVB, which is the ETF, which represents the Australian domestic banks. And just an astonishing rally in CBA yesterday has left that looking good as well this morning.
Yeah, what do you put that down to, that move in CBA?
Look, Henry and I looked around everywhere to see whether there was anything obvious, and there was nothing obvious. Having worked in the institutional broking market for 20 years, I can tell you some days, some dealer gets a blue pad and he's just ripping off strips all day because some fund manager somewhere has decided to buy something. And whilst we all look around every day for some explanation for absolutely every share price movement in the market and every market movement, the truth of the matter is that some days somebody just buys a lot of stock. So I don't know who bought a lot of stock. You might remember there was some high-profile fund managers who were saying that you should short the CBA. Maybe they decided to cover yesterday, but a 4.2% rise when the rest of the banks didn't do much was a surprise. But we'll see if that follows through today. But I don't think there's any news you need to know about the CBA. It's simply one of the safest stocks in the Australian market, too big to fail. The yield, unfortunately, isn't up at the 7-8% level, which is where you want to be buying a stock like that. But it is seen as a safe place. And as you'll see, gold, although gold's off $42 today, gold, a safe place, is hitting record highs. And the reason we bought into MVB, which represents all these domestic banks, is it is low risk compared to the rest of the market. I think whilst this trade show is going on, the banks are asleep at the back of the theatre, not really involved. And having seen a fairly decent correction, we saw it as one of the best risk-reward plays for a recovery in the markets. We're in our fund, Andrew, we're happy to make it slow. The game is just to make it and don't lose it. So we're not focused at all on relative performance. We're simply focused on making money. And when you get that mindset that you don't care what the market's doing and you don't care about outperformance or underperformance, you're just trying to make money, then risk becomes far more interesting and important to you than high performance. So that's a low risk, but very good odds of making money, which is why we bought it.